Hello everyone, welcome to today's US Open live webinar. It is October the 5th, 10 minutes before Wall Street opens. As always, I'm your host, Nikos Tsabouras, Senior Financial Editorial Writer at FXCM. The yen is in the spotlight this week on speculation around intervention by Japanese authorities. EUR/USD finds some reprieve after a slew of jobs data from the US and, of course, ahead of Friday's NFPs, while Wall Street is cautious. And, of course, we also had the Reserve Bank of New Zealand, which kept rates unchanged for second straight time. And earlier in the week, we also had its Australian counterpart also standing pat on rates. That's what we will be talking about today. But before we begin, as always, please read carefully through the risk warnings and the disclaimers, and then we will get started. Once again, please read carefully through the risk warnings and the disclaimers, and bear in mind that anything discussed here does not constitute investment advice and should not be construed as such. Let's give you a few more minutes to read those materials, and we will get started in a few seconds. Okay, let's go ahead and get started. We have quite a few things to catch up. We're going to start as always with EUR/USD, which is in a difficult spot, both fundamentally and technically. Then we're going to move over to USD JPY, which it's having a pullback after the new 2023 highs earlier in the week. We're gonna also talk about the Reserve Bank of New Zealand and the impact of this latest policy decision on NZD USD. And we're gonna then move to the US tech heavy index, the Nasdaq 100, and we're gonna round things off with the NFPs that are due on Friday. So in terms of EUR/USD, the pair is harmed by the shift in monetary policy dynamics, as we have discussed again following September's central bank meetings. The ECB, let me remind you, hinted at peak rates, and recent commentary is in line with that, despite the fact that it has not shut the door on further tightening. Now, the Fed, on the other hand, pushes the higher for longer narrative, pointing to the need for more hikes and prolonged restrictive stance. So the policy differential has shifted now, and that has been detrimental to the euro for quite a while now. And if we look at the daily chart, we can see the formation of a death cross, the technical formation of a death cross that occurs when a faster moving average crosses below a slower one. Personally, I prefer to follow the cross between the 50 days exponential moving average and the 200 days EMA. Now, such a formation is often seen as a precursor of sustained weakness, and the last time we had seen such a formation was at around July, August of 2021, and you can see this prolonged fall that eventually to last year's, the 2022 multi-year lows. So definitely in terms of technicals, it's in a precarious position. Now back to the 4-hour chart. The pair started the week with new 2023 lows, which brings 1.0337 in the spotlight. But pairs will need fresh impetus for challenging that level. On the other hand, the pair finds reprieve over the last couple of days and may get the chance to rebound, perhaps try to reclaim the 38.2% Fibonacci we have on the chart, but from that point on, the upside is unfriendly with multiple roadblocks following, for which, of course, we have spoken in previous sessions as well. And of course, the next leg of the move will likely be determined by key upcoming releases, and we're going to talk about that towards the end of our session as always. Now let's move to USD JPY. You can see here the highlighted region is a sharp fall that occurred on Tuesday, and that was after it breached 150 and set new 2023 lows, highs, sorry, 2023 highs. So Japanese authorities had stepped in the FX market in September of last year at a much lower rate than the current one at around 145.90, and again a month later they have recently been ramping up their verbal support of the yen, and that places the pair on intervention watch. Now, there was some speculation that that move we described was a result of such an FX intervention due to the sharp fall, but there has not been any confirmation around such action, so we don't know what was the cause of it. But in any case, as we said, the pair is in intervention watch because of the levels that it is at and this verbal support that we have seen increasing over the past several days. As we said, this sharp drop came after the new 2023 highs. These highs bring the next resistance at 152.2 in the spotlight, but again, fears and prospects of inaction by Japanese authorities can contain the upside, and given the quick drop we saw on Tuesday, there is now scope for sub EMA moves. The 200 EMA is at around 147.4, but strong catalyst would be needed for sustained decline past that level that could challenge 144.43. The policy differential remained stark as the Bank of Japan maintained its ultra loose setting, and although there are indications that it may be moving towards normalization, there has not been any imminent shift hinted. On the other hand, the Fed, as we said, is on this higher for longer track, and recent history showed that any FX intervention has a short-lived impact unless the policy dynamics change. Now let's go to the Kiwi, the New Zealand dollar versus the US dollar. The Reserve Bank of New Zealand has been at the forefront of monetary tightening, having delivered 525 basis points of hikes since the October 2021 liftoff. It paused its hiking cycle over the summer, though, and left rates unchanged at 5.5% for second straight meeting on Wednesday. There was a dovish tilt to the decision since policymakers did not hint at more tightening, despite calling for sustained restrictive stance. However, the last projections from July show a terminal rate of 5.6%, which leaves room for one more hike. So I would say the door is not closed there, but the bank is making progress and may well be able to stay on the sidelines. Now, immediate reaction for the pair was lower, and there is now risk for fresh 2023 lows at around 0.5858 currently. but a fresh catalyst would be needed for bears to test 0.5753, 0.5739 region, which is the next major support level. On the other hand, the Kiwi reacts and can return above the 200-period EMA. You see how it tries to do that. Daily close above it would pose the downside bias, but the upside looks unhospitable with a thick daily Ichimoku cloud looming. So you can see that it's definitely not easy to see sustained recovery there and under current conditions, with the Fed pointing to more hikes, whereas the RBNZ is more neutral, let's say, around that. Now let's switch gears and go to NAS 100. After a typically poor September, the index remains at a tough spot ahead of key releases. We're going to talk about that in a bit. And of course, the new earnings season, which will be crucial for the tech sector, since this year's rally prior to the poor third quarter was driven by artificial intelligence and gains in companies such as NVIDIA. Now, there is scope for further losses towards around 14,100, 13,000 for 8.2, and where we see the 200 days exponential moving average and the 38.2% Fibonacci of the 2022-2023 rally. So far, however, the correction is shallow, and we think the index has the ability to push higher. The immediate upside is pivotal because we have the 200-period EMA at around 15,000, and if the index is able to reclaim that that technical level, this will shift bias again on the upside and give bulls a chance to pursue new 2023 highs, which are still decent though at 15,946. Having said that, let's see what's ahead. We have the US jobs report on Friday for the month of September. There have been signs that the labor market is coming into better balance, but they are inconsistent and conditions are still tight. The last NFPs had shown an increase in unemployment to 3.8%, but job gains picked up again. This week's data showed a sharp fall in private payrolls for September, but August jobs openings increased. So a bit of a mixed picture there. And of course, one of the reasons that the Fed is sustaining its hawkish bias is because of the strong labor market. Now, next week starts slow, but things heat up in the second half with inflation updates from US and China. And of course, the new earnings season getting underway, but we're going to talk more about that at our next session, which is on Tuesday at our usual time, 10 minutes before Wall Street opens. Thank you for joining me.